Dividend investing is appealing because it promises passive income, cash being sent to you on a regular basis. That sounds great to a lot of people, but not all who jump into it find success. Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that we discuss is intended for information and educational purposes only and should not be considered investment advice or investment recommendation. Whenever you invest, your capital is at risk. Understanding the common pitfalls can help you avoid the mistakes that cause some dividend investors to fail and improve your chances of long-term success. The first pitfall is ignoring dividend growth. While high yields grab attention, dividend growth also contributes to driving wealth over time. If a company's dividend doesn't grow, inflation can eat into your purchasing power. Dividend growth helps protect and boost your income in the long run. When it comes to dividend investing, it's easy to be dazzled by a high dividend yield. After all, who wouldn't be tempted by a 5% or even 10% yield on a stock? But here's the kicker. A high yield today doesn't necessarily translate into long-term wealth. Instead, sustainable wealth building with dividends lies in dividend growth, the steady increase of payouts over time. Ignoring dividend growth can lead to lower returns, diminishing purchasing power, and missed opportunities. A real-world example of dividend aristocrats. If you take companies like Coca-Cola and Procter & Gamble, both have grown their dividends for decades, offering investors the dual benefit of income and growth. These companies don't just pay dividends, they raise them consistently, signaling to investors that they're committed to long-term stability and shareholder value. This dividend growth means an investor in Coca-Cola or Procter & Gamble is likely to see a rising income stream, enhancing returns while utilizing the increases to protect against inflation. This compounding effect can turn a relatively modest investment into a significant income stream over the years. How to identify quality dividend growth stocks. To ensure you're picking the right dividend growth stocks, focus on companies with a history of consistent increases. So look for companies with multi-year track record of increasing dividends, as this often reflects stable cash flows and a commitment to rewarding shareholders. Earnings growth. Dividend growth is only sustainable if a company's earnings are also growing. Companies with strong earnings can fund dividend increases without overextending. Reasonable payout ratios. Ideally, a company's dividend payout ratio should be under 75%. This suggests the company retains enough earnings to reinvest in growth, making future dividend increases more sustainable. And if you're looking for somewhere to buy dividend growth stocks, then a solid choice to start your research is the sponsor of today's video, Trading 212. I asked Trading 212 if they could give me a unique code that you guys can simply type into the promo code section, capital at risk. So if you've opened a new account recently or planning to open an account, then here it is. DivXP or DIVEXP, short for the Dividend Experiment. So you have 10 days from opening your account to type this in and receive fractional shares worth up to £100. I also get something as this is my custom code, so this helps you support the channel too. If you do use it, thank you for your support and thanks to Trading 212 for sponsoring this video. Pitfall 2. Failing to diversify. In dividend investing, the appeal of high-yield sectors like energy or financials can lead some investors to overcommit to one area. This is very easy to do as natural dividend payers are often found within the same sector. It's tempting to think that loading up on these high-yield stocks will increase your income, but putting too much into a single sector, or worse, a single stock, exposes you to major risks if that area takes a hit. Diversification helps to spread risk, offering a more stable income stream and better long-term returns by balancing the highs and lows across different sectors. The risks of sector concentration. If you concentrate your portfolio heavily in one sector, you're tying its performance directly to that industry's fortunes. For example, if you're overinvested in energy stocks, your portfolio's income could be hurt by falling oil prices or increased regulation on fossil fuels. A sector-specific downturn might affect not only the stock prices but also the dividends, as companies in struggling industries are more likely to cut payouts to conserve cash. This is especially dangerous during economic downturns or industry-specific crises, which can have a domino effect on both income and capital. If all your stocks are in one sector, the impact of the downturn can be severe, slashing your income and diminishing your portfolio's value. For example, the 2008 financial crisis. The 2008 financial crisis was a textbook example of the perils of lack of diversification. Many dividend investors had a large portion of their portfolios in financial stocks, banks and institutions that were known for paying solid dividends and appeared to be stable. When the crisis hit, these companies suffered massive losses, cut dividends, and some even went bankrupt. Investors with heavy exposure to financials saw both their portfolio values and income plummet, with few other assets to balance out the losses. For those who spread their investments across sectors, the blow was softened as other areas like consumer staples or utilities weren't hit as hard. Pitfall 3. The high yield trap. Chasing big numbers can lead to big losses. It's easy to be drawn to stocks with high dividend yields, especially if they promise a tempting income stream. But high yields are often a warning sign, especially if a company is struggling. This is the high yield trap. The allure of a high payout overshadows the underlying financial health of the company, leading investors to take on risky positions that may ultimately harm their portfolios. Why high yields can signal danger. When a stock's yield seems unusually high, it often means the share price has dropped significantly. This could be because the company is experiencing serious issues, declining revenues, increasing debt, or competitive struggles. High yields are sometimes the last-ditch effort of companies trying to retain investors, but if the underlying problems aren't resolved, the dividend becomes unsustainable and may soon be cut, leaving investors with a lower share price and reduced income. A real-world example of Frontier Communications. One of the stark examples of the high-yield trap is Frontier Communications, or FTR, a telecommunications company that once attracted income-seeking investors with a high dividend yield. As Frontier struggled to adapt to a rapidly changing industry and an outdated business model, it faced declining revenues, a massive debt load, and ongoing customer attrition. Despite these issues, the company maintained an attractive dividend for years, drawing in investors looking for high yields. However, the high yield was a red flag indicating underlying instability. Frontier's unsustainable dividend policy eventually led to a cut, causing its stock price to fall even further. Frontier then suspended its dividend altogether as it struggled to restructure its debt and salvage its business. The company eventually filed for bankruptcy in 2020, wiping out significant portions of investor capital and leaving dividend investors with nothing to show for their initial high-yield investment. Pitfall 4. Overreacting to short-term market swings. Why patience pays off. One of the biggest mistakes dividend investors can make is reacting impulsively to short-term market dips. Market fluctuations are natural and often driven by temporary factors like economic reports, geopolitical events, or investor sentiment. These swings rarely reflect a company's true long-term value, and panic selling during these times can lock in unnecessary losses. Holding steady during turbulent periods can allow you to benefit from recovery and long-term growth. Why short-term swings shouldn't dictate long-term decisions. Market dips are often temporary, and reacting emotionally to these swings can derail a well-thought-out investment strategy. Selling a dividend stock because of the sudden price drop means you might miss out on the income and potential price recovery that could follow. When you invest in companies with strong fundamentals and consistent dividends, short-term volatility is more noise than signal. Real-world example of Johnson & Johnson during the 2018 lawsuit crisis. In 2018, Johnson & Johnson, or J&J, faced significant turmoil when reports alleged that its baby powder products contained asbestos, leading to thousands of lawsuits and extensive media coverage. The resulting public outcry and fears of financial liability caused a sharp drop in J&J's stock price. Many investors panicked and sold off their shares, fearing long-term damage to the company's reputation and finances. However, investors who understood J&J's long history of strong performance and diversified product portfolio chose to hold their shares. J&J's core business segments in pharmaceuticals and medical devices were resilient and continued to generate steady revenue, enabling the company to maintain its dividend payments despite the crisis. Over time, the stock rebounded as the company settled many of the lawsuits and clarified its legal position. Investors who remained patient during this period saw their portfolios recover, while those who sold during the dip missed out on the gains and continued dividend income. Pitfall 5. Investing without a strategy. Without a solid strategy, you might find yourself making impulsive decisions that can harm your long-term returns. Knowing your goals, whether that's immediate income, long-term growth, or balanced mix, helps you guide your decisions and keeps you focused even during market volatility. A clear, well-defined strategy serves as a roadmap that can help you avoid common pitfalls and build consistent returns over time. Why a strategy is essential for dividend investing. Without a defined plan, it's easy to fall into reactive short-term behavior, like chasing hot trends or high yields, without fully understanding the risks. This often leads to a buy high, sell low cycle, where investors chase performance in booming markets and sell at a loss during downturns. Having a strategy tailored to your goals ensures that your investment decisions align with your objectives, keeping you focused on the bigger picture rather than market noise. If you want to see how I view strategy or what my plan is related to dividends, then I highly recommend watching this video about the metronome portfolio next. It's how I structure my portfolio for dividends and growth, and how I balance the risk within that. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!